Okay guys, we're going to try to round this chapter out this time. Sorry, 3 short videos, which I guess is better than one really long one, right? So last part of chapter 13, we're going to talk about the second kind of stock that we're going to discuss in this chapter, which is preferred stock. It's similar to common stock, but it has some advantages, so it's preferred, okay? Know for the test that preferred stock has contractual provisions giving it a preference or a priority over common stock, usually in the case of dividends being issued by the corporation or in the liquidation of the corporation in any excess assets. So those are, that is the preference. You get dibs on stuff, and you get dibs on dividends, and you get dibs on anything left over if they go out. Now we talked about when we use pick on common up here. We're going to do some preferred stock transactions, and now instead of pick on common, guess what? It's pick on preferred. So that's really the only difference between accounting of selling this stock is you have to say it's preferred stock. You're still going to use legal capital just like you did for the common. But you're also then going to change the pick on common to now be pick on preferred. So we'll go through a couple of those. Look in your book on page 14. Right before the little box at the bottom, it says, for example, if Stein Corporation issues 10,000 shares of $10 par value preferred stock for $12 cash per share. Then you start saying, okay, well, what did we get? We got cash. How many shares did we issue? We issued 10,000 shares at $12 per share. So that is going to give us $120,000 in cash. Now, what do we give up? This time it's not common stock, but it's preferred stock. So we call it preferred stock. Still 10,000 shares. But this time it has a legal capital of 10. Par value. Again, that would be stated in the charter. So many authorized shares of common at this par, so many authorized shares of preferred at this par. So 10 times 10 would give us 100,000. The difference of 20 would then be pick on preferred. So the accounting is very, very similar, except now you're using the preferred terms instead of the common terms. The third type of stock that we're going to talk about in this chapter is called treasury stock. It's a little bit of a twist here, okay? Know for the test that treasury stock is the corporation's own stock that has been issued, fully paid for, and then reacquired by the corporation, but not retired. So that means that the corporation has sold the stock out onto the stock market. They have paid, it's been paid for, recorded, all of that. They then go out on the stock market and buy their own stock and hold it, but they don't retire it. It's still an active stock. So somebody out here is not holding it. I am now, okay? Also know that treasury stock is a contra stockholders equity account. The owner or the stockholders equity accounts want to be the same as the owner's equity account capital. So they want to be credits, which means that treasury stock will hold a normal debit balance. Okay, so it's a contra stockholders equity. Also know for the test that treasury stock is reported in the financial statements of a corporation as a deduction from total pick and retained earnings. We're going to see a financial statement here in a few minutes. But it's a subtraction because that section of the balance sheet wants to be a credit, and it treasury stock wants to be a debit. So it's going to be a subtraction. We'll show you how that sets up here in a second. The purchase of treasury stock decreases common stock outstanding. Okay, know that for the test. Because you are buying it back and holding it. Now we talked about authorized. Authorized is the number, according to the charter, that the corporation can sell. We talked about issued. Those are the numbers that have been sold. Now I've mentioned the word outstanding. Let me explain that to you. Authorized, how many the charter says you can sell. Issued means how many have been sold. Outstanding means how many shares other people own. So the number of shares issued versus the number of shares outstanding, those could be different. Why? Because I may have some, and those shares will be found in the account treasury stock. So if your issued shares and your outstanding shares are different, look for treasury stock, because that corporation probably owns some of its own stock and it's just holding it. Okay? So keep in mind those three terms. We're going to look on page 15 at the bottom. It gives you some reasons why they may want to purchase some of their own stock. If you look on page 16, you will see down at the second one, illustration 13.9, what I'm talking about as far as how it's going to show. You've got the stockholders' equity section of the balance sheet, and you've got the paid-in capital. Remember, that is the contributed capital from the people that own shares of stock, and that's what's coming above par value. In this case, it's pick on common, and then it shows $5 par value for the common stock. 400,000 shares are authorized. How many can be sold in the charter? You've got 100,000 shares issued, which means 100,000 shares have been sold. Then you see it says 96,000 shares outstanding. There's a difference. The issued shares is 100,000. The outstanding, what other people own, is 96. We've got 4,000 shares missing. So if you look on down, under the retained earnings section, you'll see in red there, it says less treasury stock, 4,000 shares. That's the difference. The difference between issued and outstanding is going to be your treasury shares. And that's a subtraction from that section of the balance sheet. We're going to take a look at how we purchase and then treasury stock, and then we're going to look at how we sell it or dispose of it. So on page 16 in the middle, it says on February 1st, Mead acquires 4,000 shares of its common stock at $8 per share. Treasury stock will be recorded at its cost value. So whatever you paid for it is the amount that it goes into treasury stock. So you're going to debit treasury stock because remember it's a contra stockholders equity account, wants to be a debit. So what we got our own stock, but we call it treasury stock. I sometimes call it T-stock. Actually, most of the time I call it T-stock. So we are buying $32,000 worth, 4,000 shares at $8. I always like to track this one because at some point we are probably going to resell it because we didn't retire it, which means we're just kind of holding it, which means we have the opportunity to sell it back out. So that may happen. So we've got 4,000 at 8, or what did I say? 32. And how did we get it? Well, we paid cash. Okay, and this is the purchase. Okay, now down the road, we may decide that we want to sell some of that. So if we look on page 17, it says to illustrate, assume on July 1st, this is February 1st, on July 1st, this is going to be disposal. We are going to sell for $10 per share, 1,000 of the 4,000 shares that we bought at 8. Okay, so what are we getting? Well, we're selling it, so we're getting cash. How many shares are we selling? We're going to sell 100 shares or 1,000 shares at $10. 1,000 shares at $10 of these 4,000 that we bought. Okay, so 1,000 times 10 is 10,000. Now what it goes in at, it must also come out at. So I'm going to credit T-stock, the 1,000 shares at the $8 rate because that's what it went in at. So 8,000. Now you'll notice I left some space in between here because I could have figured it out and I could have just done it underneath with a pick like I've done before, but I didn't because eventually we may need some space in here. So we're going to go ahead and I'm just going to stick it right up in there. The difference between these two is 2. And that is pick on T-stock now. Okay, so you've got a pick on common, a pick on preferred, and now you have a pick on T-stock. Okay? Now, if we sell it below our purchase price, this was sold above our purchase price. If we sell it below our purchase price, let's see what happens. Oh, know for the test that treasury stock is recorded at cost. I know I told you that, but I didn't tell you to know it for the test. That is part of the test. So let's look at selling it below cost. When a company sells treasury stock below, look at that area. If we sell an additional 800 shares at $7 per share. So we're going to do that on October 1st. Still selling it, so I'm still getting cash. How many? I'm selling 800 shares at $7 each, okay, for $5,600. What am I giving up? I'm giving up T-stock again. 800 at 8, or $6,400. Now, we're off the other direction. Here, I needed it here. On this one, I need it, down here, okay? So, the first thing we're going to do is look to see if we have any pick on T-stock. If we do, we want to pull from there. The difference between the $5,600 and the $6,400 is $800. Do I have enough in pick on T-stock to cover it? Yes, so I'm going to pull from there, okay? So I'm going to debit my pick on T-stock for the 800. Okay. Now, if it gets to the point where you have used all your pick, then you again have to go to that retained earnings. So you have to pay attention to whether or not this balance is still available. So if I use part of this pick here, then I only have 1,200 out there now. So if I do this again at an even lower rate and I need to pull from there, then I don't have a $2,000 balance in there anymore to draw from. I have the difference between the $2,000 and the $800 or $1,200 to pull from. After that, I have to go to retained earnings. So let's take a look maybe at a couple in the back for examples. Brief exercise 6 on page 26. Garb Incorporated issues 5,000 share. Oh, this is preferred stock. Let's not do 6. We've already done that. Let's go to 7. On July 1st, Rainey Corporation purchases 500 shares of its $5 par value common stock for the Treasury at a cash price of $9 per share. On September 1st, it sells 300 shares of the T stock at a cash price of $11 per share. So, on July 1st, you start asking yourself the question, what did we get? We got shares of T stock. How many shares? We got 500 shares at a price of $9 per share for a value of $4,500. How did we get it? Well, we paid for it. We bought it. So, cash. Then it says on September 1st, we're going to sell some. So we're selling it, so we're getting cash. We are selling 300 shares at a rate of $11 per share. So 300 times 11 is 3,300. What are we giving up for it? We're selling them the shares of T stock that we have. So we're giving up T stock. And again, I like to leave space in the middle because I'm not sure which way I'm going to have to go. If I think about it, I'm getting more than what I gave for it, so I'm going to have to pick on T stock on the credit side. I a lot of times don't want to think. So 300 shares times 9. So that would be 2,700. The difference between these two is $600 on this side, and it again is pick on T stock. If I had sold it for below the cost value, then my pick on T stock would be a debit, not a credit. And that would be only if I had a balance in pick on T stock. Otherwise, it would be a debit to retained earnings. Use up what's in the pick on T stock first, and then go to retained earnings. All right, the last section of the book is basically statement presentation. So we go back to the chapter on page 19. You can see an example of a partial balance sheet there. You're looking at PIC classifications, which is capital stock. It's going to tell you each type, if you have more than one type. In here you have both. On that example, you have both common and preferred, and you can see their details. Now you see a little percent in front of that preferred on the first one listed there. We will use that next week when we're calculating dividends and stuff. So right now, you don't need to know what that's all about, but there is a percent in front of that preferred. But it's a 9% preferred stock. It tells you the par value, tells you whether it's cumulative or non-cumulative, which you don't understand yet either, but you will next week. Tells you the number of shares that are authorized in the charter, the number of shares that are issued and outstanding. Notice those two are the same. Okay. Common stock is going to tell you, in this case, there's no par, which means the charter didn't say a par for that. But the board of directors did give it a stated value of $5, so its legal capital is 5. There's 500,000 shares authorized, so that's what the charter said we could sell. 400,000 shares are issued, so 400,000 shares of the 500 have been sold. 390,000 are outstanding, which means 390,000 shares of the 400 that have been issued are owned by somebody else, which means we're missing 10. So let's keep on going. Keep that in mind. Our total capital stock then is 2.6 mil. Then we have our additional PIC, which is the PIC in excess of par, or stated value. So if you look, we have the preferred and we have the common. Those are both listed, and then that's added in, then gives you your total pick. Then you add in the retained earnings, and then you have total pick and retained earnings. But then look what happens. You have the 10,000 shares of treasury stock. That is backed out. That is a debit, so it's going to be a less. Less your treasury stock, which is 10,000 common shares. Value there is 80,000, and then your stockholders' total equity balance is there. Okay. You've got your homework. If you have any questions, feel free to let me know. I will open this homework for points up, chapter 13 and 14 at the same time, I believe. I think I did them in sections like that on Moodle. So I will open that up as soon as I release this video. So let me know if you have any questions. Have fun.